It was an economic shockwave, deliberately sent across the Pacific. The United States, under the administration of President Donald Trump, unleashed a weapon of trade: tariffs. The goal was to punish, to rebalance, to bring a global competitor to its knees. The stated ambition was to force a dramatic change, shrinking the massive trade deficit the United States had with China and sparking a grand revival of manufacturing on American soil. The assault began in 2018 and escalated relentlessly. This was not a minor adjustment. Duties climbed to 20, 30, even over 145% on some Chinese goods. This financial wall targeted a vast range of imports, affecting transactions equal to a huge slice of the entire economy of China. This was a strategy designed to weaken China. But what if it had the opposite effect? What if this economic war, intended to cripple a rival, ended up creating a more powerful and self-reliant adversary? These tariffs certainly caused panic. Markets around the world shook, and fears of a global slowdown grew. Major corporations like General Motors reported huge drops in their net income, and they directly blamed the tariffs for these losses. The International Monetary Fund issued warnings. They stated that these trade barriers would inevitably slow down global economic growth, hurting both the United States and China. But the story did not end there. A central argument is that these very measures, designed to hinder China, may have had the opposite effect. They may have inadvertently pushed China to accelerate its own long-term plans, forging a nation that is more resilient, more self-reliant, and more influential on the world stage. To understand how this could happen, we can look at history. Protectionist trade policies, created to protect industries at home, often lead to unintended and even counterproductive results. The Smoot-Hawley Tariff Act of 1930 is a powerful example. This act led to a wave of retaliatory tariffs from 25 major trading partners of the United States. The result was a stunning 65% collapse in global trade, which made the Great Depression far worse. We see similar patterns with other historical tariffs. The McKinley Tariff of 1890 and the Fordney-McCumber Tariff of 1922 both provoked retaliation from other countries and led to a decrease in exports from the United States. This recurring pattern from history provides a vital lens through which we can view the recent trade conflict. A key pattern we can observe is something called the shock as catalyst effect. The initial tariffs created a huge amount of economic uncertainty. They created what economists call a negative demand shock for China. But the economy of China did not collapse under this immense pressure. Instead, the government in Beijing responded with what were described as measured retaliations. More importantly, it sped up the pursuit of its own long-term strategic plans. This suggests that the external pressure acted as a powerful trigger. It forced China to prioritize and fast-track its goals of rebalancing the economy and achieving independence in technology. This is a classic story of adversity creating strength. An external threat solidified the resolve inside the country and accelerated strategic changes that were already underway. The policy from the United States, intended to weaken China, may have instead fortified the strategic determination of China and sped up its long-term development, potentially creating a more formidable global competitor. In the immediate aftermath of the tariffs, the economy of China faced significant turmoil. In response to the American measures, China quickly put its own retaliatory tariffs in place. It imposed duties of 10% and 15% on a wide variety of goods from the United States. These included essential natural resources like coal and liquefied natural gas, as well as crude oil and agricultural machinery. While the tariffs from the United States affected transactions equal to about 5.5% of the gross domestic product of China, the retaliatory tariffs from China targeted imports from the United States worth about 1% of the gross domestic product of the United States. Despite these new and significant barriers to trade, China managed to maintain a very large trade surplus with the United States. In the first half of 2025, the value of exports from China to the United States was nearly 3 times the value of its imports from the United States. This resilience in exports was not an accident. It was the result of a deliberate and strategic shift in the flow of trade, moving away from the United States and toward other parts of the world. China began to significantly increase its exports to a diverse set of new markets. The Association of Southeast Asian Nations, or ASEAN, became a central focus. In fact, in the year 2020, ASEAN overtook both the United States and the European Union to become the primary trading partner of China. This trend only accelerated. In the first half of 2025, exports to ASEAN countries grew by 13% compared to the previous year. The growth was especially strong in specific nations. Exports to Thailand grew by 22%, and exports to Vietnam grew by nearly 20%. The strategy went beyond Southeast Asia. Exports to other parts of Asia, including India and Japan, also sped up, growing by 7.6%. This was driven by a 14% jump in exports to India and a nearly 5% increase to Japan. Trade with the European Union also grew, increasing by almost 7%, even though the European Union had its own tariffs on electric vehicles from China. The growth was particularly strong in major economies like Germany and France. Perhaps most dramatic was the surge in trade with Africa. Exports to the continent jumped by an incredible 21.4%. Nigeria saw its imports from China increase by 34%, and Egypt saw an increase of almost 14%. Even in Latin America, while growth slowed slightly, it remained robust at over 7%, still outpacing the overall growth of exports from China. This widespread diversification was so successful that it completely compensated for the decline in exports to the United States. The net result was an increase of over $100 billion in the total exports of China compared to the previous year. An interesting side effect was also observed, known as front-loading. In the first quarter of 2025, exports from China to the United States actually went up by 5%. This happened because companies were rushing to ship their goods before new, higher tariffs were expected to be implemented. This brief surge was then followed by a sharp drop of nearly 24% in the second quarter, once the new tariffs were fully in place. The tariffs, which were meant to isolate the economy of China, effectively forced it to speed up a strategy it already had, to diversify its trading partners and reduce its reliance on the market of the United States. This was not just a defensive reaction. It was a strategic effort to build deeper economic relationships with regions like ASEAN, Africa, and the BRICS nations. By actively reducing its dependence on the American market, China inherently lessens the leverage that the United States has over its economy. This strategic shift makes the trade network of China stronger and less vulnerable to future trade actions from any single country. In a major strategic pivot, China has also intensified its dual circulation strategy. This is a policy framework created to shield the domestic market of China from volatility in the global economy. The strategy gives priority to internal circulation. This means a greater reliance on demand within China itself. At the same time, it maintains external circulation, which is the integration with the global economy. The main objective is to remove bottlenecks in key areas like natural resources and technology. This would allow for the vertical integration of its production, leading to a much higher degree of self-reliance. In simple terms, this means meeting more of the demand from people in China with goods that are produced in China, rather than with imports. This represents a fundamental change in the economic model of China. After the global financial crisis of 2008, China had already been trying to reduce its dependence on exports in a strategy called rebalancing. But the tariffs from the United States introduced a new and urgent need. China now had to reduce its dependence on imports, especially for high-end manufacturing equipment and components. The dual circulation strategy directly addresses this problem. It prioritizes domestic production for domestic consumption and self-sufficiency in the most critical sectors. This is not just an evolution of old policy, it is a rapid acceleration of policy in direct response to what Beijing sees as external threats. This pivot is designed to build the long-term strength of China by making its economy more self-contained and less susceptible to shocks from the outside world. The government of China has actively used policies to increase domestic consumption. This is seen as the primary engine for internal circulation. For example, a program called the Action Plan to promote the exchange of consumer goods used various subsidies and incentives to generate over $407 billion in sales revenue in just the first half of 2025. This shows a direct and powerful effort to stimulate demand at home. With a household savings rate of 34% in 2023, there is still immense potential for more growth led by consumption, if the government can successfully persuade households to save less and spend more. To fight the economic weakness caused by the tariffs and a weaker demand at home, China also used a full set of traditional economic tools. It has accelerated the easing of its monetary policy. This includes cutting the amount of money banks are required to hold in reserve, reducing key policy interest rates, and increasing refinancing facilities for banks to encourage more lending to specific, targeted sectors of the economy. At the same time, fiscal policy has become much more supportive. The official target for the budget deficit for 2025 has been set at 4% of the gross domestic product. This is the highest level in 30 years. The focus of this spending is on boosting public investment, especially in strategic industries and new infrastructure. The depreciation of the currency of China has also helped. The Chinese yuan fell by almost 5% in real effective terms between March and April, which provided a significant boost to exports from China that were going to markets other than the United States. A policy called Made in China 2025 was formally launched in 2015. It represents the ambitious industrial strategy of China to transform its manufacturing sector. The goal is to dominate advanced technologies and to increase the domestic content of core materials to 70% by the year 2025. The tariffs from the United States and the export controls that followed are seen by Beijing as a coordinated effort to contain the economic and technological rise of China. This external pressure has caused a significant acceleration in the implementation of the Made in China 2025 plan, pushing the country to intensify its quest for technological self-sufficiency. The semiconductor industry has become the main battlefield. Export controls from the United States have specifically targeted the ability of China to get critical components. The stated purpose is to deny China the technology it needs for breakthroughs in artificial intelligence and military innovation. This strategic denial of technology has, paradoxically, only strengthened the drive within China to become self-sufficient in semiconductors. The state has committed huge investments to this goal. This includes a $143 billion drive for semiconductor self-sufficiency and a massive fund called the Big Fund, which has already allocated over $50 billion. The way China supports innovation has also changed. Instead of giving broad subsidies to local governments, the focus has shifted to more targeted support for the leading companies in the field. The third version of the Big Fund has been strategically designed to fix specific, well-known gaps in the semiconductor industry of China. The main focus is on lithography tools and electronic design automation software, which are areas where Western companies currently have a monopoly. These intense efforts have already produced significant results. China is now able to produce 14-nanometer chips at a large scale. These are the kinds of chips widely used in consumer electronics, automobiles, and artificial intelligence applications. Furthermore, it was reported that China achieved a major breakthrough with 7-nanometer process technology in 2022. This was a huge step forward, though it still lags behind the most advanced 3-nanometer and 5-nanometer processes found in Taiwan and South Korea. More recently, researchers at Peking University revealed a groundbreaking new transistor that does not use silicon. It uses a material called bismuth oxyselenide and a new architecture. They claim it can outperform leading silicon chips from Intel in both speed and energy efficiency. This development has been described as changing lanes in chip innovation. It suggests a strategic pivot that was born out of necessity because of the limits on accessing advanced silicon technology from the West. By attempting to deny China access to this technology, the United States may have pushed it to develop its own, potentially leading to a more technologically independent competitor. This push for self-reliance is visible in other areas as well. Take the case of Huawei. The restrictions from the government of the United States, including cutting off access to Google services, forced the company to develop its own operating system, called Harmony OS. This move, born of strategic necessity, has led to incredible growth for Harmony OS inside China. By the final quarter of 2024, Harmony OS had surpassed the market share of the iOS from Apple within China, reaching about 19% compared to 17% for Apple. By the end of that year, over 100 million smartphones with Harmony OS had been shipped. The ecosystem for Harmony OS has grown beyond just phones to include tablets, wearable devices, smart home products, and even personal computers. This demonstrates the ability of China to build real, viable domestic alternatives to the dominant foreign technologies. Beyond manufacturing, China holds another powerful card: critical minerals. China has strategically expanded its export restrictions on minerals that are vital for high-tech industries. The newly restricted minerals include tungsten, tellurium, bismuth, molybdenum, and indium. These restrictions build on earlier limits that were placed on gallium. Now, any company wishing to export these materials must get a license from the Ministry of Commerce of China. The dominance of China in this area is immense. It controls approximately 85% of the global capacity for processing rare earth elements. This creates potential vulnerabilities for critical sectors in the United States, such as defense and clean energy. This control gives China significant strategic leverage. For example, during negotiations, China has linked the resumption of exports of rare earths to concessions from the United States on chip sales. The immediate retaliatory measures that China took, which included these export controls on critical minerals, show that China clearly understands its leverage in the global supply chains for essential materials. The tariffs have highlighted, and perhaps even encouraged, China to use its control over these critical resources as a weapon. This makes other nations more dependent on China for these strategic materials and strengthens its geopolitical position. The Belt and Road Initiative is the ambitious global infrastructure strategy of China, launched in 2013. Amid the rising trade tensions with the United States, this initiative has taken on a new and greater strategic importance. It serves as a vital tool for China to deepen its economic influence and trade relationships with over 150 countries, especially across the developing world. This expansion into overseas markets and deeper engagement with partner countries in the Belt and Road Initiative stands in sharp contrast to the approach of the United States, which has been to impose tariffs on its trading partners. In the first half of 2025, new investment and construction contracts for Chinese companies within countries in the Belt and Road Initiative reached a record high of $124 billion. This figure surpassed the total for the entire year of 2024. This massive surge is a direct result of slower growth at home in China and the urgent need to diversify supply chains and markets because of the trade war. Southeast Asia has been a major destination for this investment, as companies from China actively look to move their production bases outside of China, a strategy often called China Plus One. As trade barriers rise between the United States and Europe and the countries of the Global South, trade between China and its partners in the Belt and Road Initiative is expected to grow significantly. China has actively cultivated these relationships. For instance, it has eliminated tariffs for African countries. This is a stark contrast to the new tariffs that those same nations now face on their exports to the United States. This strategic engagement is helping to build a more China-centric global economic order, particularly in the developing world, which reduces the relative influence of the United States in these regions. The tariffs from the Trump administration certainly caused short-term economic pain and deep uncertainty for China. But a comprehensive look at the evidence suggests these measures also acted as a powerful catalyst. They propelled China to accelerate its long-term strategic goals. The result appears to be a China that is more resilient, more technologically independent, and more influential geopolitically. The economic resilience of China has been remarkable. Despite the direct blow to its trade with the United States, China showed incredible agility in diversifying its export markets to ASEAN, the European Union, Africa, and the BRICS nations. This strategic reorientation kept its overall exports strong. The tariffs also spurred China to aggressively pursue its dual circulation strategy, which is fundamentally reshaping its economy to be more self-contained and less vulnerable to shocks from the outside. In technology, the pressure from the United States galvanized the drive of China for self-sufficiency. Massive state investments have led to real breakthroughs in chip manufacturing. The rise of domestic technology ecosystems, like the Harmony OS from Huawei, underscores this push for independence. Geopolitically, the trade war pushed China to expand its Belt and Road Initiative, creating alternative trade and investment networks that bypass traditional systems centered on the West. In the end, this era of tariffs may be remembered not as a time that weakened China, but as a period that unintentionally strengthened its resolve. It accelerated a strategic pivot toward greater self-reliance and a more diverse global engagement. The unintended consequences of protectionism, a pattern seen time and again throughout history, appear to be playing out once more. This dynamic is fundamentally reshaping global supply chains, encouraging the separation of technology spheres, and accelerating a broader shift in global power, potentially making China a more formidable and independent global actor for the long run.